Hello, good morning. It's Tuesday, April the 2nd. We passed the April Fool's Day, so let's get back to business. We are seeing a little bit of a risk off overnight. We had obviously very strong rally both Friday and Monday, so the market's taking a bit of a breather today. But before we just dig into some of the drivers today, just take a look at this the slide here. We are launching our quarterly outlook today. It's with a specific focus on Europe, with the title "Can the Center Hold?" We got contributions from all our different strategists, both here in Copenhagen and across the world, and hopefully we'll spend some time just taking a look at it. You can find it if you go to www.analysis.saxo, and here's a couple of the highlight quotes. Obviously, we are focusing on the recession risk in Europe, especially with Germany, given the impact from Asia and the slowdown we've seen up until recently. Obviously, again, the latest data from China do point towards some stabilization there. But take some time and have a flick through. We try to give our view on where we see the markets go next across the different asset classes. But I think we start off with Brexit once again. We have now had 11 votes, 3 instigated by the government, 8 by the parliament. We're none the wiser. There was another 3 votes yesterday. They all got rejected, or 4 votes yesterday. You can see them here on the slide. They all got rejected. So I just need to move over. There you go. And it basically means that we are still in a stalemate. And what is interesting today is that the Prime Minister has called for a 5-hour cabinet meeting, almost called a crisis meeting, because it has fueled some speculation that Britain could be heading for the polls. The Conservatives is probably going to get a bit of a nosebleed from that, but obviously we are completely deadlocked. Because if there's no deal before April 10th, the April 10 EU summit, there is really risk of a long delay or potentially a new referendum. And you have a take on this, Althea, because you brought with you just a gilt chart, because I just showed the cable chart. It's quite boring. It's not doing much. Market is boxing around, but we have seen this drop in yields, and it's not only just the general yield drop we've seen across the world.
Well, in this case, as you can see, the yields have been trading range-bound since November until now. And it is true that partly of the rally that we've seen in yields can be driven also by the rally in bonds that we've seen as well, like in the past few weeks. However, this rally that we see here in the past 10 days has been matching exactly the timeline of May and the rejection from the Parliament of any deal that she was bringing up. So basically what the yields are telling us is that a hard Brexit is becoming very likely, and this is a message that it seems that investors don't like and haven't been considering much across other markets like FX or equity, right?
So they're playing it from the safe side, just a worst case scenario that if that should unfold, and I suppose also the risk to the economy is also driving the demand for bonds at this stage. So really an interesting one to follow. Again, as I said, the main thing today is this cabinet meeting, which is going to be very long, and let's see what that brings us. But again, we're still none the wiser. Let's move to the other markets. We did see a break higher yesterday, both in the Chinese CSI 300, but also the S&P closed at its highest level since October. It does indicate that the risk on is really roaring ahead still, because of the action we've seen from central banks, especially the FOMC, but also the pickup in the PMI we saw in China over the weekend. It's helped stabilize at least here in the short term, the outlook for growth, and thereby also the opportunities in the stock market. But even though and I suppose with that slightly better tone, we're also seeing a slight pickup in bond yields in the US, because it tends obviously to go hand in hand.
Yes, exactly. So what happened yesterday is that with the news coming out from China, we had a rally across all markets, and we have seen also a rally in Treasuries. And here we have a graph, and as you can see, the 10 years Treasury yields have gone up from 2.36% up to 2.5%. Today it seems that they start to correct. again. However, I think that this was a movement that was just following the market sentiment, and the reason being is that I still believe that an inversion of the yield curve is really probable. And the reason being is that the central banks are going to stay dovish, at least for this year. And as the FOMC said in the last FOMC meeting, the proceeds and maturities that they will get from mortgage-backed securities will be reinvested in treasuries with same maturities. So it means like on the longer part of the yield curve.
But at least for a change, we've seen stock markets and bonds doing what they're supposed to do. When stock goes up, bonds tend to go down, and at least we saw that yesterday, even though we had seen quite a long while here where they were both moving higher, which eventually will be unsustainable. But talk about dovishness, we had the RBA out overnight. They left interest rates unchanged, but they most certainly left the door open for a potential cut if the numbers deteriorate, especially I think they're looking at the unemployment numbers. Look at the chart here. We see the Australian dollar has not really benefited from the pickup we saw in China over the weekend, and it does also highlights some emerging political risk in Australia. There is an election here in May. The current Liberal government is expected to lose to Labour, and it basically means that tonight the budget is going to be introduced by the, we can say, outgoing government, and there will be a lot of focus on tax cuts and infrastructure spend. But probably due to the fact that there is widely expected to be a change of government, the market will probably pay as much attention to the Labour leader, Bill Shorten's, basically looking for his budget reply, because that potentially could be the one that the market should be looking at for going into the autumn. If we look at some of the other markets, we also have the oil markets. We've seen this rally continue, and it picked up some speed again yesterday. Just take a look at some of these charts here, and you see the clear explanation for this. We are looking at Brent. We are now approaching the $70 level, which is a 200-day moving average, and also a trend line from the recent lows back in December. But on the right there, you can see these are the monthly production numbers compiled by Bloomberg. And since November, when OPEC was completely wrong-footed by President Trump when he allowed Iran, or he gave waivers to Iranian buyers of Iranian oil, he wrong-footed the market. The oil price collapsed, which lasted until December. Saudi Arabia, clearly angered by this being caught in the dark, has cut production dramatically since then. Overall, we can see since November, OPEC has cut production by an almost 3 million barrels a day. Adding to this, cuts from Russia as well. Saudi Arabia alone has cut by 1.25 million, and OPEC is now down producing the least amount of barrels in 4 years. This will continue to surprise or underpin the market, and with the reason why we moved even higher yesterday was this numbers from the PMI from China over the weekend, which highlighted the economy there potentially stabilizing. So that's leaving or reducing some of the worries about growth going forward, and thereby also demand. So at this stage, as long they continue to cut, oil prices are likely to continue to go higher. We need to keep an eye on Iranian sanctions waivers when they are renegotiated, or when they're potentially reintroduced in May. Trump clearly doesn't like these oil prices, so we expect some more treats to come in the near future. I think just before we head to the calendar, which is actually quite light, Peter mentioned the Lyft merger, or the IPO yesterday, and the dismal start it had on Friday. And just take a look at the chart here. It continued yesterday. So while Snap, which was one of the, you can almost call failed IPOs, it took them 4 months to dip below the IPO price. It only took Lyft 2 days. So clearly a launch which has been mismanaged by those in charge of that, or potentially too high promises has been given. But we are now below the 72 IPO price, and that's obviously not what you want as a newly started, because it hits the psychology of the stock. Finally, just moving on to the calendar, as I mentioned, it's relatively light. We have a speaker, ECB's Brent, is out this morning. And also we got the US durable goods order this afternoon. So potentially with a relatively quiet day, no excuse not to take a look at our quarterly outlook. As I mentioned, you can find it on analysis.saxo. And hopefully find some inspiration from there. Otherwise, we'll see you again tomorrow. Thank you very much.